price breaks key psychological barriers. Now, I'm sure you've heard about chart patterns for online trading and the relationship to technical analysis. I'm sure you probably heard about double tops and triple tops and head and shoulders and rectangles and pennants and flags and God knows what else. Now, there are many different things out there. There's many different patterns. Now, if you notice on your screen, I put a whole bunch of these patterns out there. Whether you want to trade from them or not is up to you. Okay. But tonight we're here to learn about triangles. Triangles are a very distinct group of chart patterns. Now, here we have them. We have something called the falling wedge. We have the rising wedge. We have, well, let's forget the flag. We have pennants. Okay. Now, when I was in school, we learned all about isosceles triangles, symmetrical triangles, and all kinds of triangles. But ultimately, a triangle consists of three lines, a base and two side angles, two other lines converging at angles towards each other, forming an apex. A triangle has three sides, that's it. So I take together and put them all in one category. A pennant, a wedge, a pennant, expanding wedge. Okay, anything that's got two sides moving at some type of degree towards each other and has a base, in my definition, is a triangle. Now, the reason I say this, and I teach the same thing when we learn about Japanese candlesticks. Candlesticks also have patterns that people expected you or expect you to memorize. And memorize what you're supposed to do and what the action or reaction that you're supposed to have. Now, supposedly when you see a symmetrical triangle, it's supposed to be a continuation pattern continuing on the same wedge. Well, I've tested them. Using those explanations, just like when you look at a bullish engulfing or a bearish engulfing pattern in candlesticks, they tell you, this is what's supposed to happen when you see it, and this is what you're supposed to do. Well, you'll find out if you do what they tell you you're supposed to do, you'll end up losing all your money. You need to know that something is about to happen. And a triangle tells you that price is moving into the apex of this triangle. At some given point, it's got to break out either upward or downward. And you know, I've done a whole statistical study to determine, does it, following these particular set of rules that you're supposed to memorize for a triangle, does it improve your trading? Well, I found out after testing about 300 symmetrical triangles, if you followed the rule, you would be right 50.8% of the time and wrong 49.2% of the time. Just following that set of rules. Well, that's not enough of an odds to make me want to do anything. But a triangle does give us lots of information and helps us make our trading decisions. Because when we see price moving between a converging support and resistance line, we know sooner or later it's going to break out of this pattern. And if you think and get yourself convinced that this is going to be a breakout and a continuation of the previous move, because that's what a symmetrical triangle is, well, guess what? You would have been completely wrong. Yes, price eventually moved up, but price broke out downward. Okay. What we need to see is that price is moving together between the two lines. And the only thing that we need to know is that at some point, price is going to break out of this triangle pattern. There's nothing we can do until price breaks out. And there's no reason to predict anything until price breaks, because price could break out here, it could have broken out here, it could have stayed in there farther. But when we see this setting up, one of the things we want to see is the more well-developed the triangle is, and the more well-developed the trend pattern is within this triangle, the more accurate your trade will be when it breaks out. Because movement within a triangle could be all over the place. It could be just a hodgepodge of mess and still form a triangle. Or it could be a clean, nice, well-developed triangle like here. And triangles appear on our charts all the time. Now, finding triangles is difficult. You have to see them, and you have to trade with them often enough that your eyes become accustomed to finding them. Because there's no way to predict a triangle, but a triangle doesn't start and end quickly. They develop over a matter of time. So you have enough time for your eye to start seeing that triangle and that pattern. As we get this triangle developing, we have a couple pieces of key information. The width of the base of the triangle can be used, but you can't use it till you get the breakout. But at the breakout point, you can then use this width of the triangle to set your target. Because remember, you need to have a target price to set your risk reward ratios to see if you can even afford to make that trade. So the base of the triangle will serve as that target price at the breakout. Now, how do you set or determine where the base is? Okay. A lot of people will use from this point on when the triangle started to develop. I say no. You use the point where both your support and resistance lines have been confirmed, because your support line hasn't been confirmed yet until here. Your resistance line started back here. So therefore, the actual base of the triangle is when you have the two lines starting to converge on each other. And this holds true whether it's a symmetrical triangle, an ascending triangle, a descending triangle, every type of triangle, whether it's a wedge. Just categorize them all in your head as triangles, and these same rules. And this is not my rule. This is a standard market rule. So remember, a triangle pattern is a specific figure formed on the price chart, typically identified when the tops and the bottoms of price action are moving towards each other like the sides of a triangle. When the upper and the lower level of the triangle interact, traders expect an eventual breakout from that triangle. As such, many breakout traders use triangle formations to identify breakout entry points. And I keep reiterating when we're looking at charts and now breakout. The only thing that helps us at any given time is the breakout. Now there's many false breakouts. There's many times price will jump out of that triangle and jump back in. And we'll talk about that shortly. But first you have to be able to recognize the breakout. You have to recognize the triangle. So there are different kinds of triangles that can be seen on a price chart. So before you jump into trading, you should understand the difference between these formations. Okay, and we said we have rising, we have ascending and descending triangles, we have symmetrical triangles, we have wedges. Ultimately, they're all the same. You have triangles when you have the support line or the resistance line going horizontal and the other edge coming at an angle. This is still a triangle. We have the base. We have also the reverse. Okay. And then, like I said, we have wedges. Okay. Wedges, the only difference between a triangle and a wedge is in a triangle, a symmetrical triangle, they're both, the two sides are converging at the same degree. A wedge has one side converging at 1 degree and another side converging at another degree. And now, as you see here, we've taken the base of this triangle, in this case, it's a symmetrical triangle, and we dropped on the estimated target zone. But until we see whether price breaks up or down, doesn't help. So typically, a symmetrical triangle pattern, the expected directional breakout is unknown. The reason for this is that it can be bullish or bearish move have equal strength as seen through price action. When a breakout eventually occurs, it is likely to provoke a price move equal to the size of the pattern. Therefore, you should carefully identify a potential breakout in the upper or the lower level of the symmetrical triangle. And these are the ascending and descending triangles. Two other types of triangles that I explained to you. One has a horizontal support level, one has a horizontal resistance level, and the angles are, the other line is coming in at an angle, and we have a base, and we have price moving into the apex. We do the same thing to figure out the target point. Now we have pennants. Pennants just look just like triangles, except a pennant on a chart have similar shape to that of a symmetrical triangle. They typically appear during trends and have a trend continuation character. Forget the words continuation character. A bullish pennant is similar to a symmetrical triangle in appearance, but the bullish pennant formation comes after a price increase. Since pennants have trend continuation characters, the bullish pennant is likely to continue to the bullish trend on the chart. Sounds just like when somebody's trying to explain a bearish and bullish engulfing candles. It's all likely. What's likely? But they all come down into triangles. No matter what they look like, no matter what we want to call them, the explanations and the interpretations and the trading with them all come down to trading triangles. Now, the question is, how do we set or use triangles for our trading? Now, as I said, you get lots of false breakouts. So you can't just arbitrarily buy or sell when price breaks out of a triangle. You can use the triangle formation to set your stop loss for your potential trade. Because remember, you need to be able to set in your setup or in your arithmetic is your potential stop loss so that you can use it to calculate your target point to see if it fits within your risk reward ratio. So how do you move the odds in your favor? So a couple things happen. When the pattern ends, the volatility dips to a minimum and the support and resistance lines will be very close. The market will then usually start to show some preferred direction. That's the breakout. But there's no guarantee of this. As always, it's best to prepare for false breakouts and retests. The easiest way to interpret a chart pattern is to treat it as a breakout. You just wait for a clear break above the resistance. While there are instances when triangles mark important trend reversals, they more often mark a continuation of the current trend. Regardless of the nature of the pattern, continuation or reversal, the direction of the next move can only be determined after a valid breakout. So what are we looking for? Number one, we're looking at the trend. We're looking at where a price is moving, as well as how developed or how well qualified that price movement is, or how well developed the trend is within that price, within that pattern. The next thing is we want to look at volume. Volume is a little bit of a helper here. As a triangle extends and the trading range contracts, volume should start to diminish. In other words, as price is being pushed into that apex of the triangle, the support and resistance lines are getting closer and closer together. Price movements are lowering and volume should be dropping. Then when we get a breakout, and if it's not a false breakout, we should start seeing a jump in volume. So we could call this the calm before the storm. The markets get very, very calm. Then we get the breakout, which is a storm, and we should see volume increase because other traders are jumping in to trade that breakout. And the duration is important. Okay, for us, since we're doing short-term trading, we don't want to be looking at a triangle that's taken 2 months to develop. It might help us with environmental stuff, but we need short-term triangles to help us. And then the breakout direction. The future direction of the breakout can only be determined after the break occurs. This sounds obvious enough, but attempting to guess the direction of the breakout can be dangerous. Even though a continuation pattern is supposed to be a breakout in the direction of the long-term trend, this is not always the case. A breakout should be on a closing basis for it to be considered valid. So in other words, when price moves out of that triangle, whether it's up or down, just because it peaked out with a wick or peaked out to make a new high, it's not a breakout. We need it to, number one, close outside of that breakout. And it should occur with an expansion in volume. Because you can never be sure when that price will return into that apex. Price may break out and then come right back into that apex. Now, just because it doesn't mean you're wrong. A lot of times, price will jump out, move back into that apex of the triangle, and then continue up in that direction it was going. And that's why you would set your stop loss below the opposite angle of the trend, below the last swing low or swing high. So the price sometimes returns to the apex or the support and resistance level around the breakout before resuming the direction of the breakout. So let's go back to now, how do we confirm that we have a real breakout? Well, I'm always looking for only high probability trades. Therefore, I use the 3-candle rule. It may get me in a little bit late. I may not make as much profit, but I have more successful trades. So in other words, we have the breakout candle here. Okay. First candle closed outside the breakout. The next candle, let me just see if I can get a thinner marker on here so you can see a little better. So this candle was your breakout. This candle would be your confirmation of your breakout because it didn't return to the apex and it continued. I would then open my trade on that third candle based on the close of that breakout candle. I would have set my stop loss. I would have set my potential target point here, and I would have looked since I was, let's back it up. I would have set my target point here, and I would have set my stop loss here. Okay. Last swing high before the breakout. So stop loss, target, buy. I mean, sell, trade, enter a trade, but that's your sell position. Okay. Now, the little tricky thing is here we entered into a strong resistance zone. So therefore, we would have had to move our target up before that resistance zone, because it's important when we're looking at it, because we need to have a target where we could technically make it, not where it's stopped by an important zone in between. Because remember, we always want to calculate our risk reward ratio based on your trade, your own trading style, to make sure that you can afford to make that trade. In other words, is there enough profit to offset the potential loss? Okay. When all of this happens, then you would enter this trade at this point. Now, at this point, you would have made a successful trade. You would have gotten out there. If the market moved against you too quickly, you would have been stopped out here. It didn't make you a great deal of money because it didn't do exactly as you thought it would do. But when I saw the market, if I was watching my trade, when I saw the market reverse and start coming back up, I would have exited my trade anyway. Because whenever the markets don't do what you think they're going to do, you should get out. So you should have your set of trading rules and your trade all written down so that if it doesn't do exactly what you thought it was going to do, you exit the market. You don't say, it's going to correct itself in a second, or I'm going to wait. Get out of the trade, because if it's not doing what you had predicted it would do, you are in a bad trade. Just because it turns out all right down the road doesn't mean it was a good trade. Trading is all about risk management, getting out of a trade when it's not doing it yourself, managing your risk, taking that small loss so that you can afford to stay in the markets to make a bigger profit on your next trade. So to sum it up, triangle patterns are easy to spot, provide good risk reward opportunities. Traders can quickly know that a big move may be near, as well as a profit objective and amount to put at risk. Now that you have the knowledge of these three powerful price patterns, you are steps closer to becoming a more confident trader. So remember, if you do have any questions, just go to www.albexo and use the live chat button, and one of our financial analysts will be glad to answer them for you. Thank you for joining us tonight. Have a great trading week, and thank you for supporting Albexo. Good night now.